Somewhere along the fogged coast of Guangdong, factories still hum beneath the weight of the night, their chimneys breathing into a sky that never clears. And inside those walls, the machines move with mechanical precision because silence here would mean failure. Cargo ships line the docks in perfect rows, containers rising like colored fortresses under the floodlights, and for a brief moment it almost looks like victory. On paper, the figures shine, exports climbing, and profits promised, and Beijing's message to the world sounds calm and confident, that the great engine of production cannot be slowed. Yet behind that message, something fragile trembles. The rhythm of manufacturing has outrun the rhythm of demand, and the warehouses are filling with goods that no one is waiting for. Every day, the lights stay on longer. Every night, the noise grows louder, and still, the orders shrink. Across the seas, European ministers meet behind closed doors, their discussions no longer about cooperation, but about control. What began as trade has turned into a contest, and what once looked like strength now carries the weight of desperation. The hum of China's economy continues, but its tone has changed, a low vibration that feels less like progress and more like warning. And as those ships depart one after another into the dark, carrying the illusion of recovery across the water, the question rises with them: what happens when the world's factory keeps running even after the world stops buying? A surge will happen, a sudden pulse of numbers that looks like revival and yet feels like strain. In September 2025, China's exports jumped by 8.3% year-on-year, reaching approximately $328.5 billion, the fastest growth in 6 months and the largest total of the year. On paper, it looked like victory, a powerful message that China could not be cornered by Western tariffs or manufacturing slowdowns. Inside Beijing's data rooms, officials called it proof of resilience, the sign that the great machine had found new life after the shocks of the pandemic and the property collapse. But outside those walls, analysts saw something different. Shipments to the United States had fallen by 27% in a single month, the steepest drop in a year, and the apparent rebound came from selling into smaller, weaker markets across Africa, Latin America, and Southeast Asia. China had lost its richest buyer and replaced it with a web of low-margin trades that kept the numbers alive but not the profits. Many companies were now producing simply to survive, selling electronics cars and batteries at minimal or no gain, their only goal to keep the assembly lines moving and the workers paid. Behind every export chart lay a deeper imbalance, one that economists describe as the classic symptom of overcapacity. The factories run not because demand exists, but because stopping them would trigger unemployment waves and financial losses too large to control. China's apparent recovery is built on momentum without direction, a giant engine spinning to avoid stillness, and that illusion, once trusted as power, is starting to look more like panic. And if the illusion is already cracking on the surface, what happens inside the factories that are forced to run without reason? Inside China's industrial zones, the machines are still spinning, but the logic behind their motion is shifting. Factories once calibrated to global demand are now calibrated to survive because the orders are thinning and the cost of keeping lights on is rising. In July 2025, industrial profits at major Chinese firms fell by 4.3% year-on-year, and the first half of the year saw a decline of 1.8% compared to the prior period. That drop comes despite the headline "Export Rebound" because the goods are going out, but the margins are vanishing and the buyers are changing. The broader problem is overcapacity and deflation pressing from both ends of the factory floor. An official survey in July showed manufacturing activity had shrunk for the 4th straight month. Meanwhile, factory gate prices, also known as the PPI, are still falling, and consumer prices, also known as the CPI, are negative, cementing a deflationary trap expected to keep domestic demand weak. When factories operate at full tilt but margins collapse, the result is a machine losing efficiency while still consuming fuel. Workers, suppliers, and regional governments feel the strain. Factories in places like Guangdong and Hebei that ramped production to serve export markets are now stuck with soaring inventories and mounting losses, and in some cases, firms are losing money outright just to avoid layoffs. The strategy is simple: output volumes must stay high, even if profits turn red, because unemployment and debt crises are politically unacceptable. And yet this raises a further question. When the very factory set up to project strength become engines of cost and risk. What happens when the next wave of production shocks hits and those lines must idle or reset? The factories inside China may be forced to run without reason, but the world beyond their walls is responding in kind and hard. In late September, the Dutch government took control of Nexperia, the semiconductor manufacturer, majority owned by China's Wingtech technology, invoking the 1952 Goods Availability Act to block what The Economist called a worrying transfer of strategic tech out of Europe. Within days, Beijing retaliated by banning exports of certain chips from Nexperia's Chinese operations, triggering warnings that global auto production could be halted within weeks. At the same time, in Washington, officials signaled a far sharper phase of confrontation. The Scott Bessent-led U.S. Treasury described China's new export controls on rare earth magnets as a global supply chain power grab and warned that refusal to comply could drive a full-blown decoupling of the Chinese economy from the West. Meanwhile, the White House floated a sweeping plan to raise tariffs on Chinese imports by up to 100% starting November 1, 2025, unless Beijing backed down, making the most severe barrier between the two super-economies in modern times. This means that the old system of interdependence is unraveling before our eyes. Western governments no longer treat Chinese industrial expansion as a challenge to negotiate over. They treat it as a threat to contain. In Europe, trade policy, technology governance, and national security are merging into one. And in the U.S., strategy papers now speak openly about de-risking rather than engagement with China. What began as a smothering of foreign competition now feels like strategic blockade. And with these walls going up, the question becomes even more urgent. If China built its economy on exporting into open markets for decades, what happens when those markets decide they will no longer open their doors? Now the real danger is no longer abroad, but inside, because while export numbers still glimmer, at home cracks are widening and no amount of foreign orders can hide them. The property market is collapsing under its own weight after being the foundation of China's growth story, with new home prices falling 2.2% year-on-year in September and declining in 8 of the past 11 months across 70 major cities. Consumer confidence is eroding, investment is stalling, and the machinery of growth is aging. Youth unemployment for 16 to 24-year-olds surged to 17.8% in July, which is the highest on record under the current methodology, as graduates face a labor market shaped by overcapacity factories and shrinking property sector demand. The broader economy limps ahead with GDP growth slowing to 4.8% in the third quarter, despite the headline export figures, fixed asset investment falling, and deflation creeping in as producer prices continue to drop. And the worst part is that the engine that once powered China's rise is now running to keep itself alive, not to push forward, and when the domestic foundation shakes, the global system above it threatens to follow. Even though the export boom has delayed the fall, it still cannot stop it, and the question now is not whether China's economy will fracture, but how long before the rest of the world begins to feel its tremors.